You're watching Reality Check, decoding India's record-breaking growth. A day ago, the government released growth data for the first quarter of this financial year, showing India grew at 20%, a record. Immediately, government and BJP handles amplified it as evidence of a massive economic turnaround. But as many have since pointed out, the 20% surge may be more of a statistical achievement, a result of being compared to India's pandemic-induced growth crash in the same quarter in the last financial year, what economists call a low base effect. If one compares the actual size of the GDP of this quarter versus the same quarter in 2019, which was a pre-pandemic year or a normal year, it actually shows that growth this time is lower by 9%. The size of the GDP in quarter one of this financial year was 32 lakh crores. This is all rounded off numbers versus about 36 lakh crores in quarter one of 2019. Which means that while the Indian economy is recovering, it still has a considerable way to go before we can draw level with where we were before the pandemic. Look at these numbers as well of areas where economic activity is still below pre-pandemic times. Mining and quarrying, manufacturing, construction, trade, hotels, transport, communication, real estate, public administration, defense, and so on. All right, before we go across the panel, let me first go across to P. Chidambaram, former Finance Minister of India, senior Congress leader. Thank you very much indeed, Mr. Chidambaram, for joining us. You were amongst those who pointed out that this 20% is not such a record number as is being made out. But that aside, Mr. Chidambaram, would you still say the fact that it is indicating that the economy is starting to turn around?
Not yet. See, if you slide 24.4% in the wrong direction, any growth, any economic activity will be positive. For while I admit that the quarter of 21-22 is better than the quarter of 20-21, it doesn't signal a recovery because you'll have to define what recovery is. You just now on your screen put out the numbers that I tweeted yesterday. The numbers are very clear. That is, we are not yet at the Q1 of 1920. 1920 Q1 is the benchmark.
Quarter one.
2021 pandemic year is a slide. In 21-22, if you make up for the slide and go back to the 1920 number, that is a recovery. But we are not yet there yet. Therefore, how can I call it a recovery?
Okay. So the government's suggestion that this is all indicative of a V-shaped recovery. This is a phrase particularly that the chief economic advisor likes to use. You say this is premature.
See, I saw the graph that he put out yesterday in his television interview. I mean, he must honestly point out what this graph means. If you go down to minus 24 from any positive number, it will be one side of the V, correct? It's like the South Indian map, the map of South India. If you go down from a positive number to minus 24, it will be one side of the decline.
Right.
And then from 24, say if you come up by even 1.3%, 2%, 3%, 4%, and it will be the other side of the V. It will always look like a V. So what is unusual about this V? When you go down to 24, it is one side of the V. When you climb from 24, it's the other side of the V. It will happen in any country. So what is Mr. Krishnamurthy gloating about? I can't understand.
Okay. But overall though, Mr. Chidambaram, leaving aside for a minute these particular sets of growth numbers, overall though, would you say that while we still have a way to go before we can properly talk of a recovery, that there is now a gradual economic uptick, and would you give the government some credit for it, as they themselves claim that they this is not just on its own, it's not automatic, it's a result of various steps they've taken?
On the contrary, it is automatic. from a lockdown, if you unlock and people start consuming, people start going out and working and producing, it will be an uptick. But what has the government got to do with it? If the government wants to claim credit, what the government should have done is sharply increase public expenditure, sharply increase public investment. And then I can understand that the government claiming credit for that. But this uptick is not because of heightened public investment or greater public expenditure. Just look at the numbers that you put out on your screen a little while ago. It is only because people have started working and people have started consuming. This is the antidote to the lockdown. When the lockdown is relaxed and you open up, it will be a growth. Government could have done another thing. Government could have given cash doles to the bottom 20% or 25%, and they would have consumed more. The government did neither. Government did not boost expenditure by cash transfers. Government did not boost public investment. Look at the numbers put out in the budget at a glance on the first quarter numbers. Government did not boost public expenditure either. So I give little credit to the government. If you want me to give credit to any government institution, I will give fair high marks to the RBI, which ensured that there's enough liquidity in the system. But even that is beginning to return diminishing returns.
So the government says that they did roll out a number of these schemes in the earlier lot. They were called Atmanirbhar schemes. All sorts of mechanisms were created to make lending easier. A lot of money was made available to small businesses and so on. You're saying none of this actually had any impact?
See, at least a dozen economists have deconstructed those numbers, and they have come to the conclusion that the actual fiscal stimulus was only 1.3% of GDP. In fact, I was generous when I said it is about 1.7% of GDP. But what is 1.3% of GDP when your GDP has declined 7.3% in 2021? Please remember, the decline in GDP in 2021 was minus 7.3%.
Right.
So you should have done a much bigger stimulus. Many countries, comparable countries, smaller countries, bigger countries have done stimulus of 10% of GDP, 15% of GDP. We should have done at least 5 to 10% of GDP. My benchmark number was 10% of GDP.
Okay. Let me come back to a question on which we've conversed before as well, which is to do with the argument made in some quarters, including in some sections of the government, that the kind of cash that you are suggesting and others are suggesting be pumped into the economy in the form of cash transfers, especially to those who are economically vulnerable and so on, requires the government to have that kind of revenue in its hand, which particularly given this pandemic hit time, it doesn't have. Revenues are running short. To that you would say what?
Answer is borrow and spend. Even today, a newspaper has headlined as editorial, borrow and spend. That is stimulus. You borrow and spend. That is what America did. That is what every European countries did. And look at America's bounce back. America's economy has bounced back sharply. So borrow and spend. In fact, I went a step further and I was endorsed by many eminent economists. You borrow and spend. And if you think the borrowing is going to an uncomfortable level, monetize part of the borrowing. Why do you have the power to monetize? The word monetize is not the FM's invention in this NMP. The word monetize originally meant that you monetize part of the borrowing if you think that the borrowing is uncomfortable. But I don't think our borrowing will reach uncomfortable level. The best antidote to what we suffered last year was to borrow and spend more. And where are you spending? You will spend on infrastructure. You will spend on other investments. You will spend on productive expenditure. And that will have its own returns.
Okay. Borrow and spend, you say, is one way for the government to try to turn around the economy. But let's see how that actually unfolds. Mr. Chidambaram.
Can I add just one
yes.
thing? The counterfactual, it
Yes.
is difficult to prove the counterfactual, but if the government had actually given a larger fiscal stimulus, we may have achieved the 1920 GDP in 21-22. Now, by all accounts, we are not going to achieve the 1920 GDP in 21-22. We have to wait for the first 6 months of 22-23.
Okay.
Thank you.
All right, Mr. Chidambaram. Thank you very much indeed for that. Okay, let's go across to panel. We have with us Madan Sabnavis, Chief Economist, Care Ratings is with us. Radhika Kapoor, she's an economist, focuses particularly on labor economics at ICRIER. And Gurcharan Das, author and former CEO of Procter & Gamble, India. Thank you all so much for being here. Madan Sabnavis, let me just start by asking you what you made of both these numbers, the growth numbers, and the contention of several, including Mr. Chidambaram, that this is just hype to say this is record breaking. If you actually compare it to realistically to 2019 pre-pandemic, we're still under, we're still short.
Okay, I actually have a more moderate view on this, because while it is true that this is a statistical phenomenon of 20% growth, and calling it a V-shaped recovery can be contested. And today it looks like that we have reached around 90% of the level of 1920. So therefore, I think somebody can argue saying that, look, we are not really doing that well.
Yeah.
But we should remember one thing, that we had a lockdown in the first quarter of this year also. And we were quite skeptical about what would be the final numbers which would come for the economy. Was the second lockdown worse than the first lockdown? Because it was imposed at different points of time by different states. Now, given the fact that we've come to this 90% level in the first quarter, I think that has been fairly commendable. So, while I would definitely not say that it's a V-shape and something for us to rejoice, but I definitely think there is some in the sense that it hasn't
commendable
been that
in the sense that hold on,
90%.
because the argument being made is that that this would happen automatically. It's like saying, today schools, I'll open the schools, there will be people sitting in chairs, and I close it, they're not. So it's an automatic thing. It's got nothing to do with any kind of government achievement.
No, I'm not talking of the government achievement right now. I'm just saying that the fact that we've come to 90% of the pre-pandemic level is commendable, because I thought personally that conditions could be worse. Because in this particular lockdown, I think certain industries were impacted quite sharply. So even today, if you look at the industries which are really doing well, I would say it's more of the BFSI sector, the IT industry, pharmaceuticals,
BFSI,
banking, finance, banking and financial services.
Okay.
Yeah, banking and financial services, and we're looking in terms of FMC. So it's definitely seen in certain pockets. It's definitely not broad-based.
Okay.
And it's also because the last point, Srinivas, because I think the way we calculate GDP, a number of sectors, we look at the corporate profitability, and we add salaries and wages to it. So that's the value added definition.
Okay.
And corporate profitability has been very buoyant. So that's how we're getting these numbers. So I wouldn't demean the whole thing. At the same time, I would eulogize it to say that we've actually turned around. There's still some distance to go.
You're saying be nuanced. Radhika Kapoor, because you particularly look at labor data and at jobs, often these growth numbers conceal distress, unrecorded distress. What are you seeing in terms of this anomaly between this supposed bounce back and between what is actually happening to jobs and unemployment?
So there are really 2 points here, Srinivasan. The first is that if you look specifically at the Q1 numbers that have just come out, the 3 sectors outside of the agricultural sector, which account for bulk of the employment in India, these are still very much below their pre-pandemic levels. You showed these statistics in the beginning. If you look at trade, hotels, restaurants, communication, these accounted for about 18% of total employment pre-pandemic. And the gross value added in these sectors is still 30% below what it was in pre-pandemic levels. Similarly, the construction sector, which accounts for a significant share of employment, GVA is still about 15% below pre-pandemic levels. So not only is it the case that, all these employment intensive sectors are very much below pre-pandemic levels, but the other problem with this GDP data is that these numbers are largely based on what you get from listed companies in the corporate sector. They adequately capture the distress in the informal sector, which has borne a disproportionate burden of the employment losses, the income losses, and the wage losses. So a lot of the growth that you're actually seeing in these numbers is driven by these large corporates, which, as we know, witnessed record profits last year. And how did they witness these record profits? It was not because they were investing in expanding output and employing more people, but quite to the contrary, they were actually cutting their input costs, in particular labor. So despite this, sort of rebound that we are seeing in the numbers, we don't see any such turnaround in the employment numbers as reflected, by CMIE or by the government's own PLFS data,
right.
Quarterly PLFS data.
Okay. Gurcharan Das, could this be a problem that this supposed bounce back we're seeing is firstly somewhat statistical, secondly it's really only kind of reflected in the organized sectors of the economy? Look at what's happening with the stock markets, for example. And as Radhika pointed out, even with the corporates, it's really not to do with creating more jobs or passing, the benefits down the chain. It's just by actually belt tightening, laying off people, wage cuts and that kind of rationalization that they're doing so well. Could this blow up on our faces, not now, but somewhere down the line?
Well, let me say I agree with much of what has been said already. I would just say that my personal reaction when I saw these numbers was a sigh of relief, because frankly, after the tragic second wave, I had expected much worse. I mean, it was human tragedy of that sort we have not witnessed since the partition. But fortunately, when you think back, there were local lockdowns. There was not a national lockdown. And that explained, these sort of things explain it. So it's a question of looking at a little bit at the half full glass or a quarter full glass.
Okay.
No way can you call this a V-shaped recovery. No way can we say that we are going to achieve that 9% target. I think it's too early. It'll depend on the third wave and what happens.
Okay.
But let me just say one thing as we go forward, because we've talked about going backwards. Now going forwards, I think Mr. Chidambaram is right in this respect, that given the fact that the consumption, an economy depends on 4 pillars. One is private consumption, one is private investment, third is government investment and consumption, and fourth is exports. So we can't depend on private consumption. We are still in a pandemic. We can't depend on private investment because there's idle capacity. So the third is government spending. Now, it's absolutely right. Going forward, we have to see a much more aggressive effect of the infrastructure spending that the government has been talking about. And finally, exports. While it has done well this quarter, but the reality is the rupee is strengthened, that acts against it. And also, our companies have not joined the global supply chains, and they won't unless the tariffs come down.
Right.
So I would just say that let's be cautious about this in the future.
Madan Sabnavis, do you agree that that the government needs to spend more, both in terms of government investment and put money in people's hands, and the way to fund that, as Chidambaram was saying, is borrow and spend, but that does mean that your fiscal deficit goes up, you start worrying about how you're going to get downgraded with rating agencies and all that?
See, theoretically, what is being said is perfectly all right. One follows the Keynesian theory saying that if the government spends, you're able to bring the economy out from a low equilibrium trap. But just look at the situation today. We already have inflation at around 6%, and this has all been caused on the cost side. International commodity prices have gone up, domestic prices are increasing, and companies are generally loading the burden on the consumer. Now, today, if I have a situation of the government actually spending, say, 5% of GDP, and you're borrowing it or getting RBI to pay for it, it's all very fine. But will the consumer be able to bear this kind of an inflation? So I think it's a very nuanced situation that, yes, more government spending should have been done. Maybe more cash transfers should have been done. But there's a limit to what governments can do. And the last point is, just remember one thing, just merely by spending a lot of money, you cannot pull an economy out. You finally need the private sector to work out. You need to see the jobs being created in the private sector, because the government doesn't create jobs today. It's more of the private sector.
So Radhika, what would you say is the way out of this?
Well, I think, if you look at what drives growth in the economy, I mean, one of the principal drivers of growth in the Indian economy is private final consumption expenditure, and that has been declining quite steadily. And that's really now going to only get exacerbated further because of the extent of job losses that we've seen, the income losses, the wage losses. So I think as much as we focus on recovering our GDP, there needs to be a clear and strategic approach about how we are going to create more employment, how we are going to focus on those sectors that can actually create more jobs for those who are at the bottom of the pyramid or in the middle of the pyramid. Because remember, these people have not just lost jobs and incomes, but they now are being hit by a triple whammy of inflation. Because one striking thing that is coming out in this GDP data is that there is a huge divergence in the GDP growth numbers in nominal and current terms. And the GDP deflator is now in double digits. So inflation seems to be getting entrenched. It doesn't appear to be a transient phenomena. So that needs to be tackled as well. So creating more productive jobs, having perhaps an employment policy also is the need of the hour, in my opinion.
But very quickly though, Radhika, because what you say is of course absolutely valid, but it's something we've struggled with for years, and right now we're in a kind of quasi-emergency situation where you need urgent steps. If you spend more, as Madan Sabnavis is saying, when you already are inflationary, when the government is already debt stressed, that may not be an answer. So then in that scenario, what can you do immediately?
Well, to create employment, I mean, in terms of where the government directly spends, of course, infrastructure is the most direct place they can spend and therefore create jobs. But it's also about creating a more enabling environment for the private sector to invest. And given that the private sector is sitting with idle capacity, consumption is declining, there's very little incentive for the government to for private sector to invest. So perhaps one thing is to think of cash transfers. And the other is that the government already has a production-linked incentive scheme in place where they have committed to spending almost 1% of GDP. I think it's worth thinking about how this can actually be linked to employment creation and not just incremental scales to incentivize job creation.
Okay. Very quickly, Madan Sabnavis, you wanted to come in, and then last word from Gurcharan Das. Yes.
No, in fact, when you're talking of employment, see, we are in touch with some of the HR consultancy firms. Again, I would agree with Radhika. We're just talking of the organized sector. I think the news is fairly good for both blue-collar as well as white-collar workers. So if you're looking at the pipeline, I think lots of companies are actually showing interest in hiring more people. So there is a positive side to the story. I agree there's no hole for the unorganized sector.
Okay. Last word from you, Gurcharan Das. Quick, 30-second prescription, mantra.
The most hopeful number in this quarter was the fact that construction and retail have increased, and these are labor employment intensive sectors. And so I think I agree with Radhika that
the
jobs
construction
really
is still below pre-pandemic.
Well, yes, but it's recovering very quickly, and what I would just want to say is that the standard formula of infrastructure spending crowds in private investment spending, crowds in jobs. That is still the right way to go.
Okay.
But government should push it aggressively. That's all.
All right. Okay. Let's see how it actually plays out. But thank you all so much for joining me on Reality Check. Thank you so much for watching. We're out of time. Good night.